Okay, this video is going to cover the sections 5, 6, and 7 of the second reading. To start with, we are going to talk about the conceptual framework developed by the International Accounting Standard Board. This framework is basically designed to assist people setting standards for financial reporting, in guiding them how to go about their business, what's important, what sort of principles are to be applied when faced with when facing a decision on setting a standard. When people are preparing their financial statements using their standards, applicable standards, and they come to a point where they have to apply the judgment, and the judgment is that guidance is missing in the standard. There's some gray area. They'll obviously go back and refer to the conceptual framework to understand. By the way, we are going to discuss the conceptual framework in a bit, so we're just setting up stage for that discussion. Then when the financial statements are obviously prepared, the auditors, they have to form an opinion, they have to give an opinion about these financial statements. So auditors can also refer to the conceptual framework to have an understanding on what was there on the standard setter's mind, and what the International Accounting Standard Board wants to have in their financial reporting standards. Lastly, the users can obviously refer to the conceptual framework to on how to interpret these financial statements. There are six qualitative characteristics of financial reports as outlined by the conceptual framework. There are two fundamental, and then there are four other characteristics. The two fundamental characteristics are relevance and faithful representation. Relevance obviously highlights if the information presented on the financial statements is relevant for the decision maker. There's another important concept of materiality within relevance. Materiality means if an information is omitted or misrepresented on the financial statement, how is it going to cause a material impact? Faithful representation means that the information presented should be complete in all respects. It should be neutral, meaning it's free from bias, and should be free from errors. Moving on, the other four qualitative characteristics of financial reports include comparability, meaning that for example, a company reporting its cost of goods sold in year, let's say 2020, it's arrived at using similar process in 2019, 2018, and so on. That means the information provided on the financial statement has been prepared using the similar measurement techniques, and they are comparable across a number of reporting periods. The information presented, moving on, should be verifiable through a set of documents and so on. Then the information provided is provided in a timely manner, it's decision useful, and last but not the least, it's understandable for the readers. Obviously, when you're preparing these financial reports, you face certain constraints. There's a cost with providing information, and you can obviously have a cost benefit analysis, that if the cost exceeds the benefit that the users are going to get by certain information, it's better to be left out. Moving on, information that cannot be quantified, for example, market share, superior product quality, customer loyalty, creativity, all these things, these cannot be quantified in numbers, but obviously this information can be presented elsewhere on the financial statements, probably in the management's discussion, maybe. But obviously you cannot quantify this information. Now moving on, there's a section that talks about the elements that are there on the financial statements. Obviously these are the 5 accounts that we have: assets, liabilities, equity, revenue, and expenses. We are all familiar with it. So we are not going to go into detail. You can obviously refer to the reading for for refreshing your understanding on these. We are going to talk about something that we have already, probably covered in other courses, but needs some refresher here. There are these underlying assumptions in financial statements. Obviously, the statements that we are preparing are based on accrual accounting. Accrual accounting means that the activity is reported in the period it happens. For example, sales for the units sold sales for the units sold in the year 2022 would be reported in the number for sales in the relevant years 2022's financial statement, and it's going to be supported by this the relevant number in the cost of goods sold. Whether you receive the payment for this sales or not if it's received in the same year, fine. If it's not, still you're going to report the sales and cost of goods sold in the year 2022. Similarly, the statements are drawn on the principle that the business is a going concern. That means we expect that in the foreseeable future that the reporting entity would continue to operate as normal business. Then we talk about recognition of financial statement elements. So recognition means that the element on the face of the financial statement qualifies to the definition of an element of either one of these five. Either it's an asset, it's a liability, it forms part of the equity, or revenue, or your expenses. So if it qualifies to be one of these five, it is there recognized in the financial element. Now, measurement of financial statement element is one of the most challenging things that that are there for people preparing financial statements. These are a number of terms that are there. 6 of them, to be precise, that we have to discuss over here. Historical cost. Historical cost is simply the amount of cash or cash equivalents that were paid to acquire an asset. Usually, in our accounting courses, we have studied that usually land is presented on the cost it was acquired. Sometimes some of the liabilities are also measured on the historical cost. Then there's another concept of amortized cost. Historical cost adjusted for amortization of debt or depreciation or depletion or impairment. This is usually the case when we recognize or measure our property, plant, and equipment. There's a historical cost, and then we adjust it for depreciation, and then we present it on a balance sheet. Current cost. In reference to assets, current cost is the amount of cash or cash equivalents that would have to be paid to buy the same or equivalent asset today. You can also refer to this as replacement cost. Same is the case with liabilities. If you have a bond outstanding, the current cost basis of measurement would mean that the undiscounted amount of cash or cash equivalent that would be required to pay the obligation, settle the obligation today. There's another similar concept, which is realizable value or settlement value. In terms of assets, if you were to sell this asset today, what would the asset fetch? In an orderly disposal, not in a fire sale. For liabilities, it will be what it would take to settle the liability today. Moving on, the present value. Present value is obviously the discounted value of the future cash inflows from an asset, or for a liability perspective, it means the same. Then we have the concept of fair value. It is defined as an exit price, the price that would be received to sell an asset or paid to transfer a liability in an orderly transaction between market participant at measurement date. This may involve either market measures or present value measures, depending on the availability of the information.